You said on social media leading in that this was the most predictable, quote, no change in years meeting. What do you make, though, of what you heard? The market seems to have taken this at least a bit hawkish. Is that your takeaway as well?
Yeah, it's a little on the hawkish side, I think. I mean, the words of this press conference are, you actually nailed it in your intro, Scott. It's no hurry. We're not in any hurry to cut rates. And that's appropriate, I think. We've had a range-bound interest rate market for some time now, and the two-year Treasury is about 4.25% or 4.2%, and the Fed funds rate is at 4 3/8, so they're very much in sync. So I heard a very wide-open view of what the next move might be. No hurry to cut rates. Doesn't seem to be there's any inclination to raise rates at this point in time. And he's obviously focused on the stability in the unemployment rate right now in terms of not feeling a need to cut rates. The inflation rate has been drifting higher by a little bit. I mean, the CPI is up in the high 2s, and it was down in the mid 2s. And with the commodity complex being above its 200-day moving average on the Bloomberg Commodity Index, and looks like it may have bottomed out, and the price of oil is in the low 70s, and Trump wants to get the price of oil down, so he says, drill, baby, drill. But the price of oil hasn't changed very much. It's still somewhat elevated. So what's really fascinating is since the first Fed rate cut back in September, the two-year Treasury yield is up by 60 basis points. The 10-year Treasury yield is up by 85 basis points. The long bond ETF is down on price only, forgetting about the coupon. It's down by about 11%. So we have had this very unusual move that with the Fed beginning a cutting cycle, we have not seen a bond rally. In fact, the general high-quality bond market hasn't made much progress. So I think no hurry, and we're very, very data dependent. It seems like a new high has been reached in data dependency. And I worry a little bit, as I have periodically since the hiking cycle started and now the cutting cycle. I worry that we're running into a high degree of short-termism, that we're going to wait and see what the data does in just a few months ahead is what I think we're looking at. But I think market participants' takeaway from this is the Fed is on hold. And they're just going to wait for data. And so what came out of this meeting was completely expected and not a lot of insight on where we're headed other than data dependency.
I feel like we might have gotten some insight, if nothing else, into the psyche of the Fed chair when he said policy is, quote, well positioned. I mean, I think he made the case that they think they're in a really good place and they can afford to not be in a hurry, as he said. You agree with that, or do you call that into a little bit of question?
I think when he says we're in a really good place in terms of policy and the economy, he's basically saying we're on hold. And yet, contradicting that, he says we're above the neutral rate. So the implication is that we're on hold until the inflation rate goes down. And unfortunately, it's probably not going to go down very much in the several months ahead. So I wouldn't be looking for rate cuts at the next meeting. Certainly, we didn't expect one in this meeting. And so we have a relatively stable place where we're standing. And it kind of supports the fact that the market is in a calm position right now, and so is Jay Powell, apparently. There are some things that are troubling, though, regarding markets. I notice how high the CAPE ratio is on the S&P 500. It's up in the mid-30s. It's interesting that when Ronald Reagan took office, the CAPE ratio was down at about 10. And so now it's about 4 times higher, or 8 times higher anyway, than it was when Reagan took office. So it doesn't seem there's any room for valuations to expand. And so it's an entirely earnings-driven market. We're going to have to see how that develops. At the same time, the credit markets are very, very low incremental yield versus treasuries. This has been a theme that's been developing now for a year and a half. And there's not a lot of room for error. And in fact, some things have happened, if you get a little bit down in the weeds, that are somewhat disconcerting, because they're reminiscent of what was going on in the mid-00s heading into the global financial crisis about 20 years ago. And that is that we're starting to see retranching of credit risk. You remember it was the credit ratings that screwed everything up in the subprime market back in 2007 or so. Well, now we're starting to see in the resecuritization markets of bank loans, which is called the CLO market, what we're starting to see is retranching of traditional letter ratings. So, for example, there's triple B rated bonds, and all of a sudden they're retranching them into senior triple Bs and junior triple Bs. Why are they doing that? They're doing that because the average interest rate that's paid by tranching it into two pieces is lower than the interest rate if it was just a triple B. And this is a slippery slope. It's only getting started now. I don't think that it's an imminent problem. One thing I've learned in over 40 years of the investment business is you might be seeing signs that are worth taking note of, but by the time that they really develop into a consequence, it takes much longer than you think.